Welcome everybody to today's presentation. I am very excited to be here. My name is Nicole DeRosa. I'm a senior tax manager over at WIS up in Florham Park. We have a jam-packed schedule for the next 70 minutes or so. So yes, I know I talk fast. I do want to get through all the materials. So without further ado, we're going to take a little trip back in time, go over a little brief synopsis, discuss the Buildback Better bill, discuss the infrastructure bill as it currently stands right now. It's obviously not final. We're going to go through some general tax updates and then very, very brief, some kind of planning opportunities, which I know it's near impossible to kind of plan in today's environment just because everything is kind of, nothing's ever final. I feel like everything keeps changing. But a brief note on policy versus politics. Obviously, yes, we are going to be talking about tax policy today. Yes, it's politics driven. We're going to leave the politics out of it. We're just literally going to be talking about where things currently stand as they are. And that's it. So without further ado, we're going to take a trip down memory lane. As I mentioned, the original individual tax proposals, what we had kind of anticipated, which we were like, oh no, not again. You know, there's going to be significant changes. What were they originally proposed as? The high earner provisions essentially raise the highest marginal rates from 37 up to 39.6, phase out the QBI deduction for potentially, again, high earners, which when I say high earners, I really mean households of, over $400,000, if you will. And also there was intended to be a phase out of itemized deductions. There's supposed to be a cap of a tax benefit of itemized deductions as well of 28%. And there's also supposed to be a subject of wages in excess of $400,000 to the 6.2% Social Security portion of the FICA. In addition, we have some other ones. On the business side, increase corporate tax rate from 21% up to 28%, create a 15% minimum tax essentially on global book income for companies that have at least 100 million in book income, obviously, yes, bigger companies, provide tax credits to promote revitalizing, renovating, modernizing existing or recently closed facilities, expand some other tax credits with regard to domestic manufacturing, provide advanceable credits to companies that also invest in manufacturing. You see kind of a theme here, right? And establish new incentives for companies to make critical products in the US. So these were kind of the original proposals, which seems so far back now at this point. I feel like so much has happened since then. So fast forward now to kind of present day, we have the Buildback Better bill, which, the November 19th version, the House approved it by a vote of 220 to 213. The Senate has not yet voted on the bill. Obviously, it's still out there. There's still possible changes. We know there's likely to be changes. With that being said, there's not that many tax incentives kind of in there from what the original proposals were. There are some childcare incentives, some higher education incentives, some stuff on prescription drugs, some healthcare, housing, and way, way more. But obviously current state, where are we right now as of today, November 30th? I took this off of the E&Y. They put out a really nice summary chart. If you're aware of it, then that's great. If you're not, I highly suggest you read it. It's literally a nice, plain and simple summary kind of exactly where we stand now. But the estimated cost of this bill is about $1.7 trillion. It will add a net total increase to the deficit of $160 billion. $360 billion is added to the federal deficit over the course of 10 years, and ultimately $207 billion of non-scored revenue is estimated from the tax enforcement. Obviously, we heard a lot about, they want to increase tax compliance, and with that being said, increased tax compliance increases tax revenue, hence where they're getting that number from. All right, so the Buildback Better bill, try saying that 10 times fast, some noteworthy individual provisions. Essentially, there is an exclusion for comprehensive paid leave benefits, which will be then excluded from gross income. The proposal provides that any amount that a taxpayer receives as part of the newly created comprehensive paid leave, provided that under the Social Security Act, it's not included in their gross income. There is a modification for the SALT limitation. Yay. Not a total win, but it's a win potentially, because currently, obviously, we all know it's capped at $10,000. They are looking to increase this up to $80,000, which would then be extended through 2030. And this is for effective tax years 1/1/2021. So fingers crossed. If this passes, that would be a that would be great, obviously. With that also being said, obviously, yes, we have all these pass-through entity taxes that have been introduced by pretty much like every state now, I feel like, at this point. So maybe it'll become a moot point down the road, maybe not. Still, obviously, something to consider if, your client has a flow-through entity. Obviously, $80,000 it's an increase from $10,000, but it's not, obviously carte blanche. So stay tuned on that. Hopefully it'll pass. Who really knows what's going to happen, though? There has also been an extension of the limitation for certain legally married couples. There's also been expansion and modification of the child tax credit, which we're all well aware of, other dependent care credit, and the advanced payment, obviously. We knew that this was kind of going to be a hot mess. If you thought that the recovery rebate credit reconciliation was a hot mess or just a disaster in itself, in my opinion, this advanced child tax credit reconciliation is going to be a monster. So essentially, again, the expansion and modification of the child tax credit essentially extends the ARPA child tax credit expansion through 2022, making it fully refundable also on a permanent basis. Modification of the credit is effective for 2021. The refundability is effective through 2023. Extension of the ARPA EITC temporary expansion regarding eligibility, phase-in rates, and the amounts through 2022. These expansions include full refundability of taxpayers who have principal place of abode in the U.S. for more than half of the year, the increase in the age limit of a qualifying child for purposes of the child tax credit to include certain children who have not yet attained the age of 18, and also an increase in the child tax credit, the amount from $3,000 to $3,600 for qualifying children who have not yet attained the age of 6. And again, just because they're expanding it, more people are going to qualify, more people are theoretically going to be reaping these benefits. So definitely something to obviously look out for on the 2021 tax returns. I'm hopeful that the IRS will implement some sort of tool for us tax practitioners to be able to kind of see how much advance credit was actually paid, just because I don't know how else as tax practitioners we're going to actually reconcile these on the tax returns. Asking our clients to provide us 6 months of payments, it'll be interesting to say the least. Some more individual tax provisions. We have the earned income tax credit extension and modification, which extends the reduction in the minimum age to claim the childless earned income tax credit from 25 down to 19, except for some for certain full-time students. And it also eliminates the upper age limit for the childless earned income tax credit. For 2022, the provision also includes the ARPA provision, which allows a taxpayer to use their prior year earned income for purposes of computing the EITC. So we'll get into that a little bit later when we go over the 1040 as it kind of stands right now with regard to the EITC. We also are seeing the net investment income tax modification, which this is going to be a hit. And this is also kind of going to be one of those tax planning potential opportunities. It's going to be more of a wait and see opportunity. Essentially for 2020, well, it's effective for 2022, but essentially the provision amends Code 1411 to expand the net investment income tax to cover net investment income derived in the ordinary course of the trade or business for taxpayers with greater than $400,000 in taxable income, single filer, or $500,000 for married filing joint. So we're seeing a marriage penalty here, obviously. $500,000 last time I checked was not double that of $400,000. This is, again, effective for tax years 2022. So it's not a 2021 thing. However, you might want to consider potentially, foregoing accelerated depreciation if your client is kind of hovering that amount, if you want to preserve those deductions to keep them below that $400,000 or $500,000 threshold in 2022. Maybe consider opting out of bonus, or maybe not electing Section 179, maybe kind of preserving those deductions for 2022. Again, it's going to be a wait and see thing. If it's obviously passed, if it's not passed, when it's actually effective, who knows, but it is something to actually look out for. This is one of the biggies, I think, because it's only 3.8%, but that's still potentially a lot of additional tax that can be avoided if you're underneath that high earner threshold. So just something to keep in mind. Therefore, we also have the limitations on the excess business losses. It's going to be a permanent disallowance. And there is a surcharge, which we're all very familiar with at this point, on very high earners. So what does very high earners mean? What is it defined as? The provision adds a section under 1A, which imposes tax equal to the sum of 5% of a taxpayer's modified adjusted gross income that exceeds $10 million, or if you're $5 million, married filing separately, plus 3% of a taxpayer's modified adjusted gross income that exceeds $25 million, $12.5 million for married filing separately as well. Effective for tax years 2022. Again, obviously, I put very high earners in quotations because obviously, yeah, it only affects a certain amount of taxpayers who make a significant amount of money. Still very important to note, obviously, it is additional taxes. So moving along, shifting gears to some business, very minimal international, and some healthcare. So business, the corporate alternative minimum tax, essentially the 15% minimum tax on corporations with, again, adjusted financial statement income, but now it's going to be $1 billion. This is going to be effective for tax years beginning 2023. Essentially, again, not totally surprised that it's in there, the 15% minimum tax. Obviously, again, we're talking about corporations that have significant amount of money. Excise on repurchase of corporate stock. There's going to be an impose 1% excise tax on publicly traded U.S. corporations for the value of any of its stock that is repurchased by the corporation during the tax year, effective 2022. And our 1202 gains are 75% and our 100% exclusion rates for gains realized from certain qualified small business stock will not apply to taxpayers with AGIs equal to or exceeding $400,000, which also applies to trusts and estates. I will note there. These are for sales or exchanges after September 13th, 2021. So very few items that we're seeing effective for this tax year. This is one of the proposals that is currently in there that will affect this tax year. There's been numerous other credits that were added, the new markets credit for tribal statistics areas, some neighborhood homes credit, advanced manufacturing credits. There's just, again, a lot of other business credits that we're not going to talk about here, but they are out there. Again, I'll reference you to the EY kind of summary. There is a whole slew of them listed there. So shifting gears to international now, full disclosure, I know enough to just be deadly in this arena. I always kind of wave my white flag, and I consult our in-house international expert if I ever have an international related question, just because I feel like international tax has become so difficult and so complex over the last couple of years, and there's so many penalties associated with anything international. So I will say modification of the deduction for the FDII and the GILTI deduction with respect to the foreign derived intangible income is being reduced from 37.5 down to 24.8. And the deduction with respect to the global intangible low income tax GILTI is being reduced from 50% down to 28.5%. There's also some modified foreign tax limitations, which essentially this code section is amending section 904 to require foreign tax credit determinations on a country by country basis. So that is a little change there. In addition, the carry forward is going to be limited to 5 succeeding years, which is compared to 10 under current law. And the carryback of such foreign tax credit is being repealed, compared with historically under current law, the 1-year carryback. And this is effective for tax years 2023 and onward. So again, there's tons of modifications and changes in the international arena. I would say contact an international tax specialist for more information regarding all things international, just because, again, you don't want to mess with this. If you're like me, you just know enough to be dangerous. So full disclosure there. With regard to the health, essentially we have a reduction for health insurance premium costs in the bill, extending through 2025 the expansion of ARPA, the eligibility for the premium assistance credit to individuals and families with household incomes above 400% of the poverty level line, effective again 2022. So not a lot of stuff for 2021, but just stuff to kind of, you're looking forward, obviously, looking at tax planning, trying to set up your clients in the best way possible to obviously hurdle over these proposed changes. So moving along, the Infrastructure Investment and Jobs Act. This was signed into law, which seems like, I feel like so long ago, and it was really only 2 weeks ago, November 15th. There's few tax provisions in here. There's several miscellaneous provisions. There's some highway-related taxes, and there's an extension and modification of certain Superfund excise taxes. So really nothing too significant on the tax front. I would say obviously the Buildback Better bill is more tax heavy than the Infrastructure Investment and Jobs Act, but we will be discussing the ERC, crypto asset reporting, and the disaster relief kind of, a little bit more in detail. So without further ado, ERTC, this to me was kind of, again, nothing is surprising me anymore. I mean, look at last year, we had over 4 tax bills that were introduced essentially in like the shortest amount of time ever. So again, I'm not surprised anymore with anything. Essentially, ERC, most noteworthy highlight in my opinion, it ended the ERC legislation earlier. Essentially, wages paid after September 30th, 2021 are now ineligible for the credit. There is obviously an exception. There are always exceptions to the rules in tax world for eligible recovery startup businesses. Now, what is defined as an eligible recovery startup businesses? If a business began carrying on a trade or business after February 15th of 2020, they have no gross receipts for the 3-year period ending with the preceding taxable year exceeding $1 million, and they don't otherwise qualify due to a suspension in operations or a significant reduction in gross receipts. If, again, very few businesses will essentially qualify as an eligible recovery startup business, but if they do, then they are still ERC eligible. If not, then unfortunately, you're up a creek without a paddle here. ERC ended early, and wages paid again after September 30th are no longer eligible for the credit. All right, crypto asset reporting, hot tax topic. If you didn't already know, you heard it here first then. Essentially, under Section 80603, there's a new crypto asset reporting requirements for brokers. Essentially, the definition of a broker has been expanded to be more inclusive, and essentially anyone who is for consideration efficacious transfers of digital assets on behalf of another person, you are deemed to now be a broker. What is a digital asset? Any digital representation of value which is recorded on a cryptography secured distribution ledger or any similar technology. So again, more expansive, more inclusive, more people are going to qualify to be subject to these reporting requirements. And essentially, this reminds me a lot of, if we look back about, the covered and the non-covered transactions when we were like, oh my gosh, this is being introduced. It's going to be a mess for brokers. Well, I feel like we're taking, again, a trip back in time, and this is kind of similar. It's deja vu all over again, if you will. Generally effective for returns and statements that are required to be filed or furnished after December 31st, 2024. So obviously, yes, it's not an imminent change, but it's definitely on the horizon. So we better get ready for it. This is actually estimated to raise approximately $28 billion over a 10-year period. And again, I'm not surprised by this, just because we all know there's a lot of money being made out in with the digital assets and the crypto currency these days. I will also highlight on this slide, not crypto necessarily reporting, but there has been a modified threshold for reporting for 1099-Ks starting in 2022 for payments in excess of $600. Historically, you had to have, I believe it was 200 transactions and $20,000 in order to be required to furnish a 1099-K, but they're obviously kind of making this more aligned with our 1099 miscellaneous and our 1099 NEC. So again, not necessarily crypto related, but it is kind of related to reporting requirements. So I did want to kind of just slide that in there. So IRS notices regarding crypto, these are becoming more and more relevant or prevalent, I should say. So if your client receives one of them, make sure they're furnishing it to you and not just kind of disregarding it and throwing it away. Obviously, we love clients who just ignore tax notices until they see, hey, you have a lien, and then they're like, help, and it's too late. But bottom line is there's 4 tax notices that are related to crypto. Essentially, IRS letter 6173. Requires a response by the taxpayer. The heading actually says, response by date. The taxpayer may send a request for a 30-day extension. We have our CP 2000 notices, CP 200 notices, which again, obviously we all are very familiar with. They require response by the taxpayer. Taxpayer must either agree with the proposed changes of tax owed or provide additional documentation onto why they disagree with the IRS's findings. Again, we all know about these. We're very familiar. So no surprises if, CP 2000 notices received. Letters 6174 and 6174A. Taxpayer does not need to respond to these notices. The only difference in the 2 letters is there's literally one additional sentence that says, note, however, we may send other correspondence about potential enforcement activity in the future. So it's kind of like foreshadowing. Obviously, the IRS knows something is out there. They just aren't assessing any penalties or tax yet. So just so it's out there, again, 4 notices that are crypto related. And for you visual learners, I figured I would include this just because, when I think of crypto, I historically used to think of just, capital gains or, sales of crypto, buying and selling, Schedule D. But a lot of people are now getting paid in crypto. There's also, interest income as related to crypto, depending, if it's a hard fork or not. There's so many different types. People are donating their crypto. So instead of just being a Schedule D item, essentially, crypto can literally be anywhere in the tax return now. So we really should be familiarizing ourselves with crypto and at least taking a class to educate ourselves, because this is only going to become more and more prevalent and relevant. So here we see crypto on Form 1040. Obviously, we are very familiar with the check the box question, which has been moved to page 1 of the 1040. So literally anyone that files a tax return has to check this box, yes or no. If you're receiving wages in ordinary income or compensation, you're reporting your capital gains losses on Schedule 1. Again, your other ordinary income potentially from crypto. Schedule A, maybe your client contributed or donated crypto. You're going to take a Schedule A charitable contribution for it. Schedule B, some interest income. If you are reporting some wards or staking, obviously, there's tons of crypto definitions out there. Again, I highly recommend you take a crypto course just to familiarize yourself with all the terminology. Schedule C, maybe you're a miner, maybe you're, involved in the trade or business of cryptocurrency. You're obviously reporting any gains and deducting any expenses associated with that cryptocurrency income. Schedule D, summarize the crypto activity. 8949, obviously furnishing the detail of the crypto activity. So again, cryptocurrency compliance, it's not just one spot potential in the tax return. There's a lot of potential spots and different types of tax treatment. So very, very important that we just don't kind of turn our heads and ignore it. And that we also are obviously asking our clients the question, did you buy, sell, receive, or have anything associated with crypto in the tax year of 2021. CYA, ask that question along with the FBAR question. Those are, to me, 2 very important questions that we should be asking every single one of our clients. Last but not least, disaster relief. Very happy that this change has been made, just because I feel like, obviously we saw the last minute kind of, I don't even know what to call it. It was like the last minute shuffle with Hurricane Ida here in New Jersey. Is the IRS going to extend? Is New Jersey going to follow? Is New York going to follow? What's going on with the due dates? So essentially in this bill, there's a modification of an automatic extension of certain deadlines for taxpayers who are affected by federally declared disaster areas. So it's been amended to essentially mean an area in which a major disaster for which the president provides financial assistance under Section 408. And essentially, we're talking about FEMA here. So it's almost like an automatic extension, assuming that, the president declares something a federally declared disaster area. So there's no more kind of wait and see if the IRS is going to extend, if they're not going to extend. It's almost kind of like an automatic extension, if you will. Similar kind of to what New Jersey almost did this year with, if the IRS extends the due date of April 15th to May 15th, they're going to follow. So I hope that, maybe potentially New Jersey will kind of also follow suit with this. We'll see what happens. But, I'm going to say one thing. I'm going to knock on wood and not jinx myself. Hopefully we will see an April 15th due date and no more extensions. But I'm not holding my breath for anything anymore. So general tax update, here we go. I know it's super duper small. I know you probably can't read any of this, but bottom line, these returns that are still temporarily accepting e-signatures, there's a bunch of them, but the word temporary means temporary, obviously. Once we kind of go back to whatever, normal is going to be, I would expect that this list gets smaller and smaller. So just figured I'd put it out there so you see it. And looking forward now, I can't believe I'm saying this, to 2021 tax season. Here we go. The postcard is now larger. The 2018 IRS introduced the postcard, right? We all were very aware of this. It was basically a cut and paste job, which we all became very acquainted with very quickly. It has since grown in length, and we've kind of gotten back to something much more familiar prior to the Tax Cuts and Jobs Act. Again, still a cut and paste job, but we are seeing significant expansion and a trend to kind of more detail being furnished to the IRS. They want more information. They want our firstborn children. On July 21st, the IRS did publish their draft 2021 return and draft schedules 1, 2, and 3. So let's just go briefly through the various changes. Obviously, this is super small. So here's a little bit bigger for you. First and foremost, I mentioned earlier the virtual currency question. It continues to be at the top of page 1. Obviously, priority. It screams priority by the IRS. Historically, this question appeared on Schedule 1 in 2019, and really only taxpayers who were filing Schedule 1 had to actually check the box yes or no. So not every single taxpayer filing a return had to answer this question. Obviously, the IRS caught on. They wanted more people to answer this question. Heck, they wanted everyone who files a tax return to answer this question. So it was moved to page 1 in 2020. It was reworded in 2021. So essentially, it removes the word send and replaces the word acquire with dispose of. So the question now reads, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? So again, make sure you are asking your clients this question. Have it included in the tax organizer with a yes, no box maybe, or if it's not, just again, make sure you're asking your clients this question. And if they check that box yes, get more information. Do not blow it off. Moving along further down, page 1 of the 1040, our non-itemizers charitable contribution has been moved below the line. Thus, it's no longer included in computing AGI. This was extended by the Consolidated Appropriations Act and now expanded so that married filing joint taxpayers can claim up to $600 in a deduction. If you're single, married filing separate, you're capped at $300. I mean, I remember last year when this first came out, we were all kind of questioning, well, is it 300 across the board? Is it 300, 600? Now, effective for 2021, it's 300 and 600. So slight change, slight movement, to obviously below the line, but nothing significant really there. Page 2, line 19 has been updated to reflect the non-refundable portion of the child tax credit. And, we'll get to the refundable portion, which is later on. Line 28 is the refundable portion. So we have kind of a breakout, line 19, line 28. Line 27, the earned income credit has been updated to reflect the option of using your 2019 earned income. If by doing so, the taxpayer would then be entitled to a higher credit. Question has also been added if the taxpayer has not reached the age of 19 by December 31st, 2021 and satisfies all the requirements for claiming the EIC. So keep that in mind. So checkbox, additional, obviously earned income potential there. Line 30, I say this with a sigh, but there is silver lining to this. The recovery rebate credit is still around, obviously. Here we go, round 2. But instead of reconciling 2 payments, we only have to reconcile 1. So silver lining, it shouldn't be as bad. Even more of a silver lining, the IRS did actually implement a Get My Payment tool online. So instead of relying so heavily on our clients to tell us their correct stimulus payments, we can actually look them up now. So again, kind of looking at the glass half full, maybe they'll implement that or something similar for the advanced child tax credit. One can only hope. We shall see. So pages 1 and page 2, nothing significant. Schedules 1, 2, and 3, though, let's talk about those for a minute. Essentially, each schedule has been, I said earlier, they want our firstborn children. There's so much more detail being asked of tax preparers now, essentially. In preparing our tax returns, each schedule is now 2 pages. So we have moved to a 8-page 1040, if you will. Again, each schedule basically added more detail. So Schedule 1, our other income and our adjustments to income lines have significantly expanded, more detail. Schedule 2, our other taxes, has been expanded and several lines have actually been added to factor in the various tax laws changes. specifically with relation to the reconciliation of the child tax credit. Maybe somebody got too much, maybe somebody didn't get enough. If they obviously got too much, there's a additional tax, which is going to be on Form 8812. So just keep that in mind. Schedule 3, our non-refundable and refundable credits, has also been expanded. So just think of it kind of, everything's just been blown up into more line items where, historically, maybe the tax, the 89, the Medicare tax, the net investment income tax, it was, just a checkbox, right? And then we had the total. Now they're being broken out into separate lines. So again, just more detail. I hope our tax softwares do a good job of mapping, but with all the changes, there's probably going to be a lot of bumps in the road. So you might want to buckle your seatbelts. Earned income tax credit. As we know, ARPA implemented the following changes, which are applicable for tax year 2021. The minimum age requirement has been lowered. Historically, it was 25. It's been lowered to 19. There is an elimination of the requirement for taxpayers with no qualifying children to be under the age of 65. Whole bunch of other kind of, expansions under there, raises the income at which the phase out also begins. So it's basically becoming more inclusive. More people should be eligible for this credit. So keep that in mind. Maximum investment income has been increased to $100,000, and certain married filing separate individuals may now be eligible to file the credit or claim the credit. Obviously, when you file married filing separately, you're not entitled to a lot of certain tax breaks or tax benefits, tax credits, if you will, this being one of them. But now, since it's been expanded, certain married filing separate individuals may actually be eligible to claim the credit. And taxpayers may substitute their 2019 earned income for their 2021 earned income for purposes of depending, obviously if it's a greater result, you elect to take your 2019 earned income for the credit calculation. So again, just changes to the earned income tax credit, which depending on your clientele, maybe you see a lot of, maybe you don't. It's just, again, important it's out there. So here we go. Round 2, a recovery rebate credit, which is obviously being continued into 2021. Notice 1444 were, allegedly sent out by the IRS. I maybe saw a handful of these in practice. I don't know if the IRS just sent them out or didn't send them out, or where they sent them, and if our clients just threw them away. I don't know. But reality check here, these notices are not being retained by clients, at least the majority of clients, if they actually receive these notices. So again, I mentioned earlier, the IRS introduced a new Get My Payment tool, thank goodness. It's called Economic Impact Payment Information Center, which the taxpayers or, maybe interns, if you will, if you want to have an intern project, if you have January tax season interns, they're not really busy yet, maybe run a tax query, and, taxpayers can go online and check the status of their EIP, and ultimately using the Get My Payment tool. So maybe it's something that we can take and, put into the work paper file. So we're not heavily relying on our clients to tell us what they think they received or what they didn't receive, when we all know they probably received it, or vice versa. So the IRS obviously were very well aware. They noted that, they were processing returns. If there was a mismatch, it was essentially going into a second level of review. Earlier this year, they issued their guidance on, regarding the reconciliation. If it was filed incorrectly, they would automatically update the return and issue the refund or send a notice as such. This review ultimately took an average, I would say, of 16 weeks of a processing time. I do expect this to continue with, next year's return processing. Obviously, they have the advanced child tax credit to reconcile now on top of the recovery rebate credit. So we thought 16 weeks of processing time was a long time. I say maybe it'll even be more next year. But back to EIP round 3, qualifying children may receive the EIP, but depending on the phase out limits. Ineligible people involve non-resident aliens, adult dependents, deceased taxpayers before 2021, and individuals without a social security number. And again, I mentioned the IRS has the Get My Payment tool, which I strongly encourage you guys to check it out. Social security number, address, I think zip code, just basic identifying information is needed to actually receive the credit amount or the payment amount, if you will. So just a quick example, last year, if you tuned in for my update, we went through several examples. But, bottom line is, you have access to the slides, so feel free to go through these examples. Nothing significantly has changed, but I will highlight the one, which I feel like we're seeing more and more, obviously, when, and kind of it's like a scratch your head one. But in 2020, we have Emma, who was a college student senior. She was claimed as a dependent by her parents. Emma did not receive EIP3 in 2021, but in 2021, Emma's parents will not be claiming her as a dependent. Emma is a single taxpayer and expects her AGI amounting to $65,000. So the credit that's ultimately calculated is $1,400, but Emma received nothing. Obviously, she was claimed as a dependent in 2021. So she's going to be able to claim an additional credit amount on her tax return of $1,400. So again, this is kind of one of those loopholes, which I feel like is just important to note because, yeah, obviously the parents got benefit for Emma, assuming their income thresholds were underneath the phase out limits. And now Emma is also reaping the same $1,400 benefit. So something just to kind of keep out there. We did see a lot of that this past year and obviously expecting to see that moving forward into 2021 tax year as well. Sick leave, family leave. The mandate expired on December 31st, 2020. However, the credits were extended and expanded by both the Tax Relief Act and the American Rescue Plan to employers who offered the benefits on a voluntary basis. They didn't have to offer them anymore, but if they chose to offer them, there was a potential tax credit that they could reap the benefits of. Essentially, there's additional standards, for people who qualify for the paid sick and family leave. They were added and expanded. And again, just to kind of provide incentive to provide these voluntary benefits to taxpayers. And the Family First Coronavirus Response Act, the leave payments are fully taxable to employees and are required to be separately identified. Essentially, Form W-2, Box 14, as I like to call the dumping box, essentially. So our Box 14 might be a little crowded for 2021 W-2s, essentially because the reporting is done separately based on the period of the covered the period that's covered. So from 1/1 to 3/31 and from 4/1 through 9/30, there's different periods because there's ultimately different amounts. Sick leave paid, that was, the $511 per day limit. Sick leave wages that were subject to the $200 per day limit. We have different periods, we have different amounts, hence Box 14 is, like I said, it's going to get very crowded. Separate reporting is only required if their employer actually claims a refundable credit for the wages. If they didn't claim a credit, then there's not going to be any separate disclosure, any reporting that's required. So unless you prepare W-2s for your client, you're kind of, you're off the hook. This is going to be probably more of a burden on the payroll companies. So I do feel bad for them, but it's just something that we obviously have to now look out for as tax practitioners and not just, blow off Box 14. Make sure we're really looking in Box 14 or potentially the separate statement that might be provided with the W-2. Self-employment tax deferral. So essentially what happened, and now we're in the aftermath, essentially. So as we know, the CARES Act allowed employers and self-employed individuals to essentially defer payments of the employer's share of payroll tax. The deferral period was from March 27th through December 31st of 2020. So again, the period has come and gone. We're now in the aftermath, if you will. The deferred payroll taxes must be paid 50% by the end of this year, 50% by the end of next year. And the payments are to be made using the EFTPS system online. The IRS has specifically said to keep these repayments separate from all their tax payments. I'm foreseeing there's obviously going to be issues if they are specifically telling people to do that. But they don't want you to obviously lump in an extension payment or an estimated tax payment with the deferral repayment. They want you to keep it separate. And again, I'm sure there's probably a good reason for it so they can identify them more easily. But again, EFTPS system by the end of this year, 50% and 50% by the end of next year. Unemployment compensation. CARES Act, obviously, as we are well aware, provided, I believe it was like March 11th of this year. They came and they said, March 14th, essentially, we can exclude $10,200 essentially from gross income. If your household is under $150,000, this is not to be extended for 2021. As of right now, obviously we know that there's still a lot of people collecting unemployment. However, the exclusion from the gross income of that $10,200 is not available for 2021. Mark my words right now. I don't have a crystal ball. I don't know. I feel like this was a major plot twister for our tax season. We knew it was coming, or we were afraid it was going to come, and we kind of just did one of these once it was passed, because so many people had filed their tax returns already, and we just knew it was going to be a disaster. So coronavirus-related distributions, moving along now. Distributions that are made from an eligible retirement plan to a qualified individual. The aggregate amount was $100,000. So again, from January 1st, 2020 through the end of last year. So again, it's come and it's gone. We are now dealing with the aftermath. So distributions are generally included in income ratably over a 3-year period, starting with the year of receipt. Recipients may repay all or part of the amount of the distribution within the 3-year period after the date that it was actually received. And ultimately, we're going to go through some examples in a little bit just to kind of nail this down. It's quirky, and timing is really everything. And we, like I said, whatever happened. Now we're dealing with the aftermath. So, if your client did take a CRD and they chose to defer it, you're going to obviously be dealing with this. The ratably, 1/3 potential of the pickup, or, if they chose to repay it, you're going to be dealing with it. So, I put a note in a lot of, my clients' work paper files just to, alert the preparer and the reviewer for next year, hey, CRD was taken in 2020, make sure that you're factoring this into 2021. So a couple of examples here. We have Amy received $75,000 from a 401k on December 1st, 2020, and treats the $75,000 distribution as a CRD, utilizing the 3-year ratable inclusion. Amy then makes one recontribution in April 10th of 2022 of $25,000. Amy files her 2021 tax return on April 15th, 2022. So I said it's all about timing, right? Without the recontribution, she should include the $25,000 in income with respect to the CRD of each of her 2020, 2021, and 2022 tax returns. But as a result now of that recontribution, Amy should include essentially $25,000 on her 2020 return, 0 in income on her 2021 return, $25,000 in income of her 2022 return. Again, factoring in that recontribution, factoring in the timing of that recontribution, it's really it'll get a little dicey. So again, just make sure that, you're asking your clients a question if they do, recontribute or not, essentially, if they did take a coronavirus-related distribution back in 2020. Something to just not blow off. Refresher on meals and entertainment. This probably looks very familiar if you attended last year's tax update. Generally, taxpayers may still deduct 50% of the food and beverage expenses associated with operating their trade or business, but new for 2021 and 2022, the Consolidated Appropriations Act allows full deductibility for eligible meal expenses. It was dubbed the 3 Martini lunch. That's how it hit news headlines and newspaper headlines, if you will. Essentially, 100% tax deduction for food or beverages expenses that were paid to restaurants as long as the business owner or an employee of the business is present with the food or beverage being provided and the expense is not lavish or extravagant in nature under the circumstances. So obviously intended to help the hard-hit restaurant industry. Restaurants include businesses that prepare and sell food or beverages for retail customers for immediate on-premise and or off-premise consumption. Restaurants do not include businesses that primarily sell prepackaged goods not for immediate consumption, such as grocery stores, convenience stores, that of the like. So, our job here, just make sure we're educating our clients, make sure that we're properly treating this for tax purposes and not subjecting the potential restaurant meal expense to 50%. We should be allowing 100% tax deduction. So that's probably, in my opinion, the most major change. Some miscellaneous tax updates moving along. So we have our standard deduction, which, as we know, has been adjusted for inflation under the Tax Cuts and Jobs Act. We have the additional standard deduction for qualified disaster losses. If a taxpayer includes a net qualified disaster loss on Form 4684 and does not itemize their deductions on Schedule A, the taxpayer may claim an increased standard deduction using Schedule A. Keep this in mind, obviously. Hurricane Ida hit New Jersey, we all know, significant flooding, significant damage. So for your non-itemizers, this might be something that you would be considering for filing the 2021 tax return. Essentially, you're listing the amount next to the Schedule A line, Schedule A line 16 as a net qualified disaster loss. You're attaching Form 4684. You're then listing the standard deduction next to line 16 as a standard deduction claimed with qualified disaster loss. you're combining the two amounts and entering it on line 16. And you're not entering anything else on Schedule A except for this disaster loss. Obviously, if you're itemizing your deductions, completely different story. This is for my non-itemizers. So just keep that in mind. Qualified disaster losses for non-itemizers. Obviously, looking at our standard deduction limitations, slightly increased. Married filing joint, we're sitting at $25,100. Single, $12,550. The nice thing about this, yes, it's still doubled. No marriage penalty here. Blind or over the age of 65, married, $1,350 for each item. Single, $1,700 for each item. If you're a dependent, $1,100 or earned income plus $350 if greater. So again, no significant changes here, but what I wanted to highlight is really the qualified disaster losses for non-itemizers, since I do foresee this obviously being pretty relevant for our New Jersey clients if they were unfortunately affected by Hurricane Ida. Section 179, adjusted for inflation, again, under Tax Cuts and Jobs Act, no changes really, except for just obviously the amounts. The acquisition limit has been increased to $2,620,000. Income limit increased up to $1,050,000. And our SUV limit, $26,200. So again, just slight inflation adjustments, but nothing really crazy here. Our mileage rates, don't shoot the messenger. They went down. 2022, I'm guessing, maybe they'll go up a little bit. Things are a little bit more expensive right now. Standard mileage rate, 56 cents per mile. Medical rate, 16 cents per mile, same as moving. And our charity is a statutory rate of 14 cents to the mile. This is fixed. It's never going to change. Medical and moving, it's based on, the variable costs, and, our business rate is based on an annual study of the fixed and variable costs of operating a vehicle. So again, like I mentioned, they went down for 2021, TBD on 2022. We'll see what happens. We still have a month left in the year. So, anything can happen, right? Retirement limits, no changes from 2020. The amounts are the same as last year. I will note changes that were made with the Secure Act. If a taxpayer reached the age of 70 and a half in 2019, the prior rule applies and the taxpayer must take their first RMD by April 1st of 2020. However, if a taxpayer reaches the age of 70 and a half in 2020 or later, they must take their first RMD by April 1st of the year after they reach the age of 72. Like IRAs, HSA contributions also may be made up to April 15th of the next year. So this is one of the few kind of tax planning opportunities that, you can make after the year end. Slight inflation adjustments here, nothing significant though for the HSAs and deductibility. There has been additional preventative care benefits that were added in 2020 by the CARES Act, which include telehealth, some tax-free reimbursements of feminine hygiene products, and over-the-counter medicine. And the Taxpayer Certainty and Disaster Relief Act of 2020 did permanently extend the 7.5% of AGI limit for medical expenses. So, it was supposed to revert back to 10%. Yeah, that never happened. We're still sitting at 7.5% for medical expenses on Schedule A. And I will also note, I put a little asterisk there for a reason. Maximum contributions cannot exceed $8,200, even if there's two single plans that you have within the same household. And our tax rates. So, let's briefly talk about the marriage penalty and bracket cap or bracket creep. I've talked about marriage penalty a little bit here. So in the lower brackets, obviously our marriage filing joint typically is double that of single. Until you hit the 37% bracket, then you have a marriage penalty that essentially occurs, just looking and comparing the two. Inflationary adjustments have also kind of highlighted this bracket creep. If you look at the details, they're small, but they are there. For example, if you have a married couple with $100,000 of income, they would incur tax in 2021 of $13,497. In 2020, they would have incurred tax of $13,580. 2019, tax of $13,717. So cumulatively, over the 3 years since the Tax Cuts and Jobs Act, tax has actually been reduced by $220 in this example. Tax is reduced by $83 or less than 1% from 2020 to 2021. tax is reduced by 137%, which is less than 0.9% from 2019 through 2020. So again, just bracket creep and marriage filing penalty. Just, want to highlight that there for you guys. And again, I like when things are laid out nice and clean. And to me, I'm a chart girl. So here's my little summary chart for you all. Again, married filing joint versus single for 2020 and 2021 comparison. And here we have our preferential tax rates, something that I'm quite happy with, did not make it into the bill. We were all kind of, crossing our fingers because we saw that there was going to be a big issue with, first of all, the bifurcation of the year with regard to, the long-term capital gain rates being treated at potential ordinary rates. I just saw big red flags and so glad it didn't make it in. But who knows what will happen next year? Maybe that provision will ultimately make it in. But for 2021, our preferential tax rates, based on our ordinary incomes, obviously are 0, 15, 20%. We don't have any bifurcations of the years for taxing anything at, different rates based on the tax bill, because it never made it into the tax bill. So just figured I'd lay this out for you. Nice and easy. Head of household, married filing joint, married filing separate, and single. Essentially, again, 0, 15, 20% based on our ordinary taxable incomes. No significant changes, obviously, from last year. Everything is kind of, in line, if you will, just slight inflationary adjustments. Similar to our AMT, 26% rate still applies to the first $199,900. Married filing joint, if you're married filing separate, $99,950. For a child from which the kiddie tax rules apply, the exemption may not exceed, there's a whole full-blown calculation there. I'm not going to go into it, but bottom line, again, I'm a chart girl, so here's your chart: married filing, your filing status, and the different amounts for, the exemption fully phased out, when the phase out begins, and the actual amounts for 2021. And our penalties for informational filings, very important. Again, small increases. I think they increased maybe like a whopping $5 for return. And this is a small business with gross receipts of 5 million or less. So if you're 5 million or more, you have slightly different penalties. So just keep that in mind. This penalty is assessed based on when the return is filed, how late essentially the return is filed. So essentially, if it's 30 days late, it's $50 for return. But if you're after August 1st or not even at all, it goes up to $270 potentially if the return is due on January 1st. Depending on obviously, again, based on time. So don't just blow off 1099 and informational reporting. Obviously, yes, intentional disregard is a steeper penalty because, well, obviously it's intentional disregard, and there's potentially no limitation on that penalty. So again, prepare and file your forms 1099, distribute them to the recipients other than the IRS on time, and also maintain a record for completion when it's filed, when it's distributed, and ultimately, again, CYA. Okay, very, very hot topic these days as well, identity theft. There has been an expansion of identity protected personal identification numbers, IPINs. Try saying that 10 times fast. Any taxpayer that has a social security number or taxpayer identification number for primary, secondary taxpayer, and or even dependent is eligible to obtain an IP PIN. There is an online tool. Get an IP PIN. You can just go online and literally get an IP PIN. There's no requirement to file form 14039, which, in order to obtain one, like I said, anyone can literally go online and obtain this PIN now. The IP PIN is valid for 1 year. However, each January, the taxpayer must obtain a new PIN. You cannot electronically file a tax return without this IP PIN. If a taxpayer has requested an IP PIN and they just lost it, they don't have it, they don't have, whatever the reason is, if they requested it and they don't have it, you can't electronically file that return. I have a client who, unfortunately, every year they, even after I say, take a picture of it, send it to me early, make sure you don't misplace this piece of paper, make sure you don't lose it. They never have it. And ultimately, we always have to paper file their tax return because, they're married filing joint, their spouse doesn't have a IP PIN, but, the taxpayer does. You can't e-file this return. So again, just make sure that if your client does have an IP PIN, they furnish it to you. It is not the same PIN every year. And there is an opt-out. There is not currently an opt-out feature. So if you opt into this program right now, you're kind of stuck in the program. Fortunately, the IRS is looking into an opt-out feature later on for taxpayers who wish to ultimately unenroll from the program. So just keep that in mind, obviously, as well. If you're getting an IPIN because you want to, you can't not get an IPIN for the subsequent year. You're stuck in there until the IRS actually adds this opt-out feature. All right, pass-through entity tax payments. Obviously, we are very familiar with the BATE here in New Jersey. We are quite familiar with the pass-through entity tax payment for New York. It might ultimately become a moot point for some who just would benefit on the partial SALT cap modification, but again, kind of to be determined. Obviously, that hasn't been passed yet. It's in there, but we obviously don't know what's going to happen yet. So don't count their chickens before they hatch. Ultimately, nothing has been signed, making it final. But, partnerships, S corporations could deduct, obviously, state and local income taxes against ordinary income with no add back required for the individual partner shareholder level at the federal level, essentially. Currently, there's a slew of states that, have implemented some sort of pass-through entity tax payment legislation, or, maybe they have proposed legislation, or maybe they have vetoed legislation. This list is growing. It seems like every state is kind of coming out of the woodworks these days with their version of the New Jersey BATE or the New York PTET, but essentially paid at the entity level, flow through entity level, partnership S corporation, and the tax deduction is allowed in computing the entity's non-separately stated taxable income or loss for the year of the payment. IRS Notice 20-75 basically is the guidance for this. So client questions it. Here's the IRS Notice 20-75. It is a legitimate tax deduction for businesses. You obviously, for New Jersey, you have to elect into the BATE, have that payment made by December 31st, 2021 in order to receive that, 2021 tax deduction. Unfortunately, New York has kind of come and gone with regard to the election for 2021. So if you were able to elect in by the deadline, great. If not, you got to wait till next year. Unfortunately, the ship has already sailed. So some state nexus issues, obviously telecommuting, hybrid work environment, still very, very relevant. I know a lot of states kind of came out and said, oh, we're issuing our temporary guidance for remote working. But obviously, with the kind of return to office and the kind of, I'm going to call it the permanent hybrid, because I feel like now every business has some sort of permanent hybrid arrangement. It's obviously still very, very relevant. States that do have a for the convenience of the employer rule, very familiar with, obviously, with us being here in New Jersey, because we're basically surrounded by them all. Connecticut, Delaware, New York and Pennsylvania are literally the ones that ultimately were affected by. And again, telecommuting by definition is an employment arrangement in which the employee works outside of the employer's office. And obviously with COVID, this translated to us obviously working from home and pretty much has affected everybody in one way, shape, or another. For people like myself, who fortunately I live and I work in New Jersey, it's a non-issue. But we obviously see a lot of taxpayers who live in New Jersey, work in New York, potentially move to a whole other state and still work in New York. But ultimately, this rule became very, very relevant as there was a significant shift to the work from home hybrid arrangement. New York, for example, they require the employer to withhold New York state tax from all wages if the employee, if the reason that the employee is working from home outside the state is for the employee's own convenience. So again, at the onset of COVID, it was very temporary, it was very fluid, but now that's kind of shifted to a more permanent basis. So again, Nexus, telecommuting, it's still very, very relevant, something to obviously look out for. And now bringing it all together. So essentially, we have the above the line charitable contribution deduction for 2021. Taxpayers who don't itemize can take advantage of the $300 above the line deduction for cash contributions, $600 for married filing joint. We have an increased limit for cash contributions as well. The AGI limit for cash contributions made to qualified charities has been increased to the 100% of AGI through 2021. I will caution you again, GoFundMes are not charitable contributions. They're not qualified 501c3 organizations. They are not charitable contributions. I saw a lot of that this past year, and I expect to still continue to see it a lot next year and probably for every year thereafter, just because I feel like GoFundMes are very, very popular these days. RMDs, they've resumed for the 2021 tax year, essentially. They must be taken by December 31st unless the taxpayer turned age 72 during the year, which then defers the start date to April 1st. Taxpayers at least age 70 and a half should consider making qualified charitable distributions up to maybe $100,000 per year directly from a non-Roth IRA to a qualified charity to therefore reduce their AGI. Because obviously the qualified charitable distributions do count towards your RMDs. I will caution something that, I think is going to also be very obvious. When preparing returns and comparing prior year work papers to current year work papers, obviously last year people didn't necessarily take their RMDs because of COVID. You didn't have to, right? So if we're preparing a return for 2021 and we're looking back at the 2020 work papers, we are not going to necessarily see that, 1099-R if they chose not to take their RMD. So just keep that in the back of your mind when you're, reviewing returns, preparing returns, that just because they didn't have a 1099-R last year in 2020 does not mean that there's not going to be one in 2021. So do not miss that 1099-R. Moving along, child tax credit for eligible taxpayers in 2021. Child tax credit was increased and became fully refundable. The credit was increased by $1,600 for children under the age of 6 and by $1,000 for those ages 6 to 17. And, the increase starts to phase out for joint filers, obviously with, higher AGIs. The phase out for the increase is calculated separately from the phase out for the base of the $2,000 per child credit. So we essentially have two phase outs in 2021. Hopefully our tax software gets this right. I am keeping my fingers crossed, but just figure I'd mention it there. Our qualified medical expenses, personal protective equipment purchased to prevent the spread of COVID still qualifies as a medical expense, starting with periods beginning or after January 2020. So masks, hand sanitizer, now eligible to be paid or reimbursed under the medical expense account, such as FSAs, HRAs, HSAs, MSAs as well. If a medical expense account is not used and the items are not reimbursed by insurance, the cost can be included as a deductible medical expense. So keep that in mind as well. And the expense must obviously exceed 7.5% of AGI, not 10%, just because obviously that 7.5% now is permanent. And I say permanent because in the tax realm, when is anything really ever permanent, right? It's permanent until the next tax bill changes it. We have the repayment of the deferred Social Security tax. So again, what's happened has happened. We are now in the aftermath. So the repayment of the 50% due by the end of the year. And we also have our net operating losses. So for most taxpayers, NOLs can only offset 80% of taxable income in a taxable year. Any NOL that's remaining is then carried forward indefinitely. There's obviously an exception for farm losses, which we don't see that often, but if they're out there, there's an exception for you. And the CARES Act obviously temporarily did change the NOL carryback rules for tax years 2018, 19, and 20. So if your taxpayer did have an NOL, make sure you are carrying back that loss on Form 1045. And if you're able to fax it in, if you're under the page count, fax it in. Otherwise, you're stuck with snail mail. But definitely make sure you're getting in those NOL carrybacks in a timely manner. And last but not least, bringing it all together on this slide, are excess business losses. The non-corporate taxpayers can deduct a net trade or business loss up to a maximum of $262,000. If you're married filing joint, $524,000 in tax year 2021. The cap is back on. It was lifted for 2020 under the CARES Act. It is now back on. We have our excess business losses again. Business gains and losses that are reported on Form 4797 must be included in this loss calculation. So do keep that in mind as well. Any excess loss then becomes an NOL, which is carried forward to future tax years. And quick hit list. So obviously we are just about in December. We are just about in the tax planning. We are really in the tax planning phase at this point. But year-end planning, it's underway. So make sure you're engaging in the tax bracket management. Obviously right now is a big loss harvesting time of the year. Make sure you're reducing the exposure to the 3.8% net investment income tax and 199A limits. Again, I mentioned at the onset of this presentation, it's not obviously passed yet, it's not signed, but if you're a high earner, that 3.8% net investment income tax will apply to you whether or not you're active in the trade or business or not. Obviously, historically, you're active, you're not subject to it. You're passive, you are. But, under the proposed rules or the proposed tax law, if you're a high earner, you're going to be subject to the net investment income tax. So if you're hovering around that high earner, potentially, maybe you want to preserve some expenses for tax year 2022, which is when this 3.8% would hit the active trader business taxpayers who are high earners. Consider income shifting, legally income shifting, Roth conversions, because the backdoor it's back in the bill. Obviously, we don't know if it's going to pass or not, but right now the backdoor Roth conversion, the proposal is back in the bill. Maximize contributions to your retirement plans. Tax efficient investing, monitor legislation. I cannot stress this enough. I should put like a big star on this one, just because obviously, we know there's going to be changes coming down the hopper. So just stay up to date with that, and whatever tax software you use for research, make sure you're paying attention. That's where I feel like I always get my my updates from. I get an RIA checkpoint email like every night, and I'm just looking at the bullet points and reading it if it's a tax update with regard to legislation. And obviously check the IRS websites for updated FAQs. This past year, actually, I guess past 2 years, if you will, ultimately the FAQs have been written in plain English, which is really, really nice, because historically it's written in gibberish. But ultimately, the FAQs are very, very helpful. There's a lot of good information and clarifying information in there. So here's our little disclaimer. And Mark, hi. I told you I'd run right up to the time. We're at 1:11, so we're
right up there. I think we have a couple more minutes, and we do have a few questions. If you want to head into that folder, the questions for today, there should be 5 questions in there. We may not necessarily get to all of them, but if there's any of them that are kind of quick hits that you can answer, you might just want to read the question out and then answer.
Sure thing. All right. So question, how can you as a tax practitioner look up what a client received for EIP3? I thought that was a specific taxpayer individual IRS account. Is there a tool for practitioners? And the answer is yes. There's a Get My Payment tool. Where you literally, it's very similar to like the 1099G tool, if you will. If you're familiar with that, you put the social security number. I think it's social security number, name, zip code. It's certain identifying information. I think date of birth is also in there. But as a tax practitioner, obviously we have that information. We have dates of birth, we have social security numbers, we have zip codes, and I'm not sure exactly what information is, but I tried it out and it did work. So you can go on. Again, it's the IRS's Get My Payment tool, and it should tell you what payment was received or should have been received for EIP round 3. Let's see. Under non-taxable crypto, hold on, that just jumped a little bit. Under non-taxable cryptocurrency events, does giving coins require the filing of a gift tax return if the amount of the coin given is over or at the annual limit? So yes. If it's over the annual limit, technically it's a gift. Crypto is deemed just like any other capital asset. Just like if you gift stock, think of it as the same thing, even though obviously it's a little bit different. We all know it's a little bit different, but it falls underneath the same umbrella. So yes, watch out for those gift tax potential limitations there, the annual exclusions, with the gifting of cryptocurrency. And I did have a question that was actually asked in another session I had taught about, what if I pay somebody in crypto? Am I issuing a W-2? Am I just filing, a 1099? What am I doing? And the actual answer to that was yes, you are actually receiving a W-2 for the cryptocurrency computation. So just to kind of keep on the crypto train. Doesn't the increase in the SALT limitation raise problem with the alternative minimum tax? Yes, because obviously that is an add back for AMT purposes. So if you have, hypothetically speaking, if it's passed and it's an $80,000 cap now instead of 10, that would be an AMT add back. So it could potentially throw you into AMT. Obviously, there's a lot of other facts and circumstances that would surround that based on other add backs or AMT preference items. But yes, very, very good question and something to obviously consider. So, if you're electing the BATE or the pass-through entity tax, you're obviously then paying the tax at the entity level. Your SALT cap will not necessarily be affected on your individual tax return per se. So just, again, yes, AMT will be obviously affected.